Emerging markets are in a hole. Wielding the spade today was Kazakhstan, with its tenge tumbling 22% against the dollar after the currency was allowed to float. That came just a day after Vietnam devalued its currency, the latest in a run of devaluations. Now, those with long memories will be reminded of the East Asian crisis of 1997. An inappropriate fixed exchange rate came under attack amid broad dollar strength. The central bank held on before eventually capitulating, wasting much of its reserves in the process. The panic afterwards led to a domino effect across the region, capital flight elsewhere in emerging markets, and the eventual default of Russia. There's another parallel too. Developed market stocks have beaten emerging markets over a 10-year period for the first time since the 10 years from the pre-crash 1997 drop, a sign of just how far emerging markets have fallen. This chart here shows the total return on the main developed market index down here in red and on emerging markets in blue, and they're both done with dividends reinvested. You can see the scale of the recent EM fall is really quite serious, although nowhere near as drastic as it was back in 2007, 2008 and 2009, but still quite bad. And today it's just testing the lows that it hit in 2011, although as I speak it hasn't quite gone through them yet. It's a dangerous thing to say though, but this time does look different to what was going on in 97. Kazakhstan and Vietnam themselves don't even qualify as emerging countries, being banished to the outer realms of the frontier markets by MSCI. The bigger emerging markets have floating currencies already. Most of them also have very large foreign exchange reserves. In the main, they're not being caught with the classic EM problem of having to raise their rates even as their economies slow in order to protect their currencies, at least so far. Although it has to be said, stagflation-ravaged Brazil is a very important exception to that. Now, others may end up following in the footsteps of Brazil, with the big commodity producers seeing their currencies hammered particularly hard, as are those with political troubles such as Malaysia and Turkey. Turkey's lira fell a lot today. But EM reserves are big, and they were built up in the good times precisely so that they could be run down again when the fast money pulled out of their countries, as is now happening. This chart shows one simple proxy for global dollar reserves, the amount of treasuries the US Federal Reserve holds on behalf of foreign central banks and other official institutions. Now, it went up very fast as emerging markets were doing well, particularly in 2007, post the crisis starting about here, 2008, 9, 10, 11, right until the taper tantrum in 2013. And it's been pretty much flat ever since, although on a shorter term basis some of these swings do look quite fast. Now, while there's a real sense of fear about EM, it's hard to see the trigger for a genuine crisis. Indeed, lots of measures show less panic now than there was during the taper tantrum 2 years ago, when prices swung about more rapidly and emerging market ETFs had trouble keeping up, both in bonds and stocks. They seem to be behaving rather better recently. Instead, this looks like a long, hard slog. That's good news for emerging markets which have been reforming and restructuring their economies as capital was pulled out, or at least it's relatively good news. Things are going to be tough, but not necessarily a crisis. But for investors, it makes it no easier to call the bottom of emerging markets. And trying to do that means deciding on the outcome of the intertwined effects of weak Chinese growth, the nearing first rate hike out of the Fed, and tumbling commodities, and working out how those three things will interact and hit EM.